So Monday after the bell, Tesla released some really fantastic earnings, which we're going to talk about. However, since then, the stock has been dropping rather consistently. Why is that? Well, as Keenan Grace says, so you could buy it. But is that true? Let's talk about it. Also, I got a new setup. So if you're watching this video, you probably already watched or read the Tesla earnings, but we're going to go over some of it just so I could drive the point home as to how good of an earnings report this was. So for starters, the Model 3 was the best-selling premium sedan in the world. Now that is market dominance right there. Automotive revenues, automotive sales jumped from 5.1 billion to 9 billion year over year. That's a 75% increase. Gross profit increased 82% to 2.3 billion. And gross margin increased to 26.5%, which is absolutely fantastic. Total revenues, which includes all their solar stuff, but we're going to get into that in a little bit. Year over year increase of 74%. Tesla made 10.3 billion in this quarter alone. Operating margin increased from 4.7 to 5.7. I mean, look at this net income. They went from 16 million to 438 million net income. That's their bottom line. That's GAAP. And their non-GAAP is even better. So as far as vehicle deliveries, the Model 3 and Y, a year-over-year increase of 107%. 180,338 vehicles produced. That surpassed everyone's expectations according to the news I read earlier this month. And total deliveries, 184,877. That's a year-over-year increase of 109%. Again, surpassing everyone's expectations. And it doesn't stop with automotives. Solar deployed, a year-over-year increase of 163%. 92 units deployed against 35 from last year. Storage deployed, 445 units versus 260 last year. That's a 71% increase. So not only is Tesla dominating in the automobile space, but they're also starting to find their own way, and they're also starting to dominate in the energy space as well. Both energy production and energy storage. Autopilot and full self-driving. Now this is one of the things that's going to change the world if this gets developed fully and correctly. And the fact that Tesla is doing this, like, if this goes as expected, or even half as expected, they're going to absolutely dominate the market in a whole new industry. As far as their outlook, they expect to get 50% average annual growth, that's year over year, in vehicle deliveries. Now, if they achieve that, then their revenues are going to shoot through the roof. Anyone familiar to my channel, you know how I love balance sheets. They went from 37.2 total assets, 37.2 billion total assets to 52.9 billion total assets. That's the highest it's ever been. And that's compared to 28.5 billion in liability. So they got close to twice the assets. And their cash and cash equivalents holding very strong. As a matter of fact, if we take their cash and cash equivalents alone, right here, and we compare it to their debt, down here, they can pay off their entire debt, their total debt, all of it, if they wanted to, just flat out with their cash, if they really needed to. Now that right there is liquidity. So that was just a quick overview of their earnings. Now, if you have the time and you haven't yet, I highly recommend you read through the whole thing and then you listen to the transcript. There's a lot more in there that I don't have the time to go over, like the development on the factories and all that stuff. But one thing I want to point out from the transcript is this line right here. But this right here is a part of the transcript from Elon Musk. So I'm not 100% certain next year, but I think it is quite likely. I like to say, more likely than not, that in 2022, Model Y is the best-selling car or truck of any kind in the world. Now that's a forward-looking statement. We don't know how that's going to play out in reality. But if that is true, then Tesla is going to dominate the market, flat out. If we take a look at the current analyst estimates, now these are estimates, so we cannot take this as gospel, but it's a good place to start an opinion from. If we take a look at the current year, they're expected to go from an EPS of 2.24 to 4.38 at the end of this fiscal year, and by the end of next fiscal year, 6.03. They're expected to raise 57%. As far as their track record goes, they missed one, but as far as their track record goes, they will probably beat this. And they're expected to go 31% the next year. Like, these are phenomenal revenue numbers. As far as their EPS growth, they're expected to go 95% this year, 37% next year, and then 37% each year after that, at least for the next 5 years. Now, that assumes nothing changes with the company over the long term, which I don't think anything will, at least nothing negative. And you think with that news and that strong earnings report, the stock would be up. But it most certainly is not. Since the earnings, the stock has dropped by about 5.9%. At the time of this recording, I'm recording this on Wednesday evening. You'll be seeing this Friday morning. The stock is at $694.40. So given the very favorable earnings, in my opinion, the very promising outlook, the very high ratings the analysts have given it over the next several years, and the drop in price, it's time to buy, right? Am I going all in? Well, let's talk about that. So this is my portfolio. For those who are new to my channel, I show my portfolio every single week, no matter what happens in the market. So as you can see here, I don't really stick to one type of investing. There are stocks that I buy for growth purposes, such as Facebook, Cloudera, Hyliion, Revolve, Tapestry. There are stocks that I buy strictly for dividends, such as AT&T, Verizon. And then there are stocks that I buy for value reasons. Not stocks that I think they're going to 10x the market, but stocks that I think that will safely give me good returns over a long period of time, such as FedEx, Johnson & Johnson, Qualcomm, industries like that. That being said, no matter what type of investment I go for, be it dividend, growth, value, I include value in some manner as part of whether I buy a stock or not. The price does matter. Am I going to earn all the money in the world that way? Absolutely not. But I think my strategy allows me to earn a lot of money, or as much money as possible, while still retaining a degree of safety. So all these stocks here, Hyliion, Cloudera, I didn't buy these at all-time highs. I prefer stocks that, excuse my language, have gotten the shit beat out of them. I prefer stocks that I think have great, great potential in the next 5 to 10 years that have come down a lot in price. For example, Hyliion. I didn't buy Hyliion at $25. I didn't buy Hyliion at $40. I waited to a cost basis of $11.76. That's when I bought in. Revolve and Tapestry, some of my best performing stocks. Actually exactly my best performing stocks. I didn't buy these at all-time highs. I didn't buy this at $49. I bought Revolve at a cost basis of $13.68. I bought Tapestry at roughly the same price. Again, no matter what I'm going for, value is part of my assessment. The only exception is with Tesla. Now, I bought Tesla last August, and at the time I bought it, it was at its all-time highs. Now, despite me doing very well with the stock, as far as principle is concerned, I think that was a mistake. I am mad at myself for buying Tesla at all-time highs. I don't like it. It's against my nature. So now that I talked about where I'm coming from, let's talk about Tesla. If you are a value investor, if you are looking at Tesla from any kind of a fundamental valuation method, and we're going to use Yahoo Finance just to keep things simple, Tesla does not meet any of these valuations as far as being a good price to buy in on. Now, do I think Tesla is a fantastic company? Absolutely. Do I think Tesla has a fantastic future? Yes, I think that Tesla will dominate the market. However, from a purely valuation standpoint, I do think that Tesla is overpriced. Now, I was going to do a DCF for Tesla based on different valuation models. However, I found a channel and a video that already did the work for me as of the end of December. The channel is called Finding Alpha, and I will leave a link to the video in the description. But you should definitely check this out. Now, I'm not going to play the entire video because you should watch it on your own. But he does various increasingly bullish scenarios for DCF. This is the only one in which the stock price makes sense. So this right here assumes revenue growth of 35% year over year for the next 5 years, and then 30% revenue growth after that each year for the next 5 years after that. And then this also assumes a profit margin, a bottom line profit margin of 15% for the next 5 years, and 25% for the next 5 years after that. And that gives a share price, fair value of $831.80, and as without a margin of safety. And when you're doing DCF, you probably want to apply a margin of safety. With a 25% margin of safety with this video, the buy price will be $623.85. So even then, I guess the price is still a little expensive for that. Yeah, even then, the price is still a little expensive. But, I mean, it depends on your opinion as to how much Tesla's going to dominate the market. Now, Tesla's going to do very, very well, especially by analyst estimates, but is it going to do this well consistently for the next 10 years? Your answer to that question determines whether this is a good price or not. If you include price analysis as far as undervalue, overvalue, and any part as far as your assessment of a company, Tesla, I mean, including DCF, this price is probably not a good buy point. Now, if you already own shares of Tesla, I mean, it's a no-brainer. You just keep on holding. But as far as a buy point, if evaluation has any meaning to you, it's probably too high of a price. However, there are some investors who are all about growth, and with growth investors, valuations like these, they don't matter as much. I know I watched a video from Financial Education who talked about this. When it comes to, growth stocks like Tesla, when you compare them against companies like Amazon and Google and stuff, what's more important in that aspect is how much this company is going to dominate the market. And in that instance, yeah, I can see someone buying in at this price, especially if you're that bullish on, Tesla dominating the market. So if you are a pure growth, high risk, high growth type of investor, then Tesla might still be a buy to you. I mean, Tesla has all the workings, and as far as the estimates and whatever, like Tesla is probably going to dominate the market. But if you're more of a value, if you value a little bit more safety in your investments, then Tesla, you might want to wait a while and see if the price goes down. And if the price doesn't go down, then that's fine. There are other ways to make money. There are other stocks. There are other stocks that are going to make money in the long term. I'm sure of it. Now, as far as what I'm doing with Tesla, right now I'm going to hold. I'm not going to do anything. I'm not going to buy, and I'm most definitely not going to sell. Now, as far as value versus growth with Tesla, like I'm willing to meet in the middle. So if this price continues to drop, and if it hits maybe the 600s and 500s, especially the 500s, I might have to break my value rule and start buying some shares very slowly. But it would have to hit the 500s for me to start buying more than that. But anyways, take care, have a great day, and eat your vegetables.